Okay, welcome everyone to the Gamma Optimizer live video. As usually around this time of the call, I am asking if you can type on the chat. You can hear me and you can see the video. Usually with YouTube, even though I configure this for low latency is still high, so it will take a few seconds for you to hear my question and for me to see your answers. But if anyone can type, it will be good. My system shows that everything is fine in terms of sound and video, but please confirm. Okay, well, can you hear me, Peter? It's just I don't want to do a full video. Okay, perfect. Sound is good. I guess we don't have anyone in the meeting, but it's okay. As long as there is only one person, I think it works okay. Okay, so let's see what we have in store. So, in terms of closed positions, I closed the positions early last week. I could not take the positions to the end, so we took a couple of partial losses, and I will say that even though if you add all the partial losses, it's still not a full system loss. I think that we need to reconsider what we're doing here, and we need to reevaluate if the market is really being very volatile and dealers are not pricing correctly. We should really evaluate this and try to consider which should stop BRP 320 or any BRP trade. I mean, if variance risk premium is not enough, I don't think we should do any variance risk premium trades. No, that's kind of the way I see it. So we'll see. In terms of the market regime, the GT level is at 4,696 SPX, and we are short gamma by a lot. We are short gamma by more than 100 points, more than 2%. We are seeing tremendous imbalances. We see 35 billion to the upside buying and 46 billion downside. So if the market moves up, then buyers will have to come into it, and if it moves down, sellers will come into it. So market should be very volatile in the near term. And in general, the whole month of January has been extremely volatile. And I think the dealers, it's price the risk completely, and they are going to probably lose some money or earn substantially less than they used to earn. And along the same note, I think that this short gamma regime is lasting longer than I expected. It is really lasting longer. And I don't know, I mentioned last week in a post that we should keep an eye on this, because bear markets always, that's kind of the sign of a bear market, a persistent short gamma regime. I'm not saying that we're in a bear market. I'm saying that a persistent short gamma regime is an early sign of a potential bear market. So let's see. This could be probably just normal January action for a year where the Fed is about to remove liquidity from the market. So that's it in terms of market regime. We are short gamma. We should expect to see elevated realized variance in the near term. Also, for those of you that are new to the GT level, remember that if we are short gamma, any bounces are to be treated with suspicion. Don't trust any bounces. It doesn't mean the market is going up. The main trend is down. So the market goes down, and then it bounces, and it keeps going down, and it bounces, it keeps going down even more. So the bounces are just part of the whole downside trend. The only way the trend can be broken is if the market for some reason manages to go above the GT level, which is like 2% up. The good thing about short gamma is that a 2% move is so easy to, it happens easily. It's not like when you are long gamma, 100 points is like infinite points. But now in short gamma, 2% is like, it could happen in a heartbeat. In a few minutes, you could see 2% due to the massive buying that option dealers have to do. They have to hedge. Okay, so in terms of volatility, it's interesting because the month-to-month volatility is still very low at 15.7 because it hasn't captured yet the you know, the January is only like 2 weeks, so it's still not capturing the full January. But for the week, you can see it's 19.84. It's very elevated. The weekly variance is very elevated. The market has been very, very volatile for the past week. It is very high. It's not seasonal. It's not what you should expect to see in January. And along the same lines, VIX is only 22.49. It's good. I mean, at least it's higher than 20. And I think that dealers are just starting to price risk into VIX. I don't think they are fully convinced that risk is here to stay, and I think they are way behind the curve. If you do just the computations based on variance risk premium, it should be around 25 to 27 VIX, and it's only 22, so this is like they are leaving a lot on the table. I don't know what it is. It's a mystery. I've been trying to figure out why VIX is so underpriced for the current regime. So no idea why. Maybe the mystery will be revealed at some point. You know, at some point we'll know what it is. But I think it's probably that there is some massive selling happening in some place. Someone is selling options massively, and it's affecting how options are being repriced. Let's look at the term structure. Here in the term structure, we can see that finally we are getting some reprice. I don't know if I don't think in YouTube you can see my mouse, but in the first 50 days, you notice that the curve is slightly inverted and flat, and then you have contango, like 40 days on, 50 days on. So at least it's being repriced in the near term. It's higher than 20 in the near term, but it's still very low. This is not the shape of the curve I will look. If I were an option dealer, I will not price options like this at all. This shows that they think that all this volatility is pretty much around the Fed meeting. No, that's what it is. They are kind of like volatility around Fed meeting, volatility around this, and then more or less business as usual. I think that they are not pricing yet the fact that the Fed is going to remove liquidity from the market. Maybe it is due to dealers not believing that it's going to happen. Maybe they don't think the Fed has the guts to actually remove liquidity in a big way from the market. And so I think there is still room for repricing here. And then time with our trades. If this remains, if really implied volatility is not priced correctly in terms of the expectations, we should not do VRP trades. I mean, we should not, because that's what we are trying to do. We are trying to extract the mispricing from options versus realized. But if realized is going to come higher consistently, which has happened the last 2 weeks, you can see this realized variance has been consistently higher than it has been priced in the options. Then that means that we are going to lose money for a while, and you know, it's better just to sit in the silence and wait until variance risk premium becomes something manageable, something that we can extract money from it again. And remember, folks, that we are in YouTube, so it is a little delayed. The video is a little delayed if you ask questions, so please try to ask the question and interrupt me, and I'll stop and come back to you guys as soon as I can. Okay, so in terms of realized variance, here is even worse. And you can see on 2022, you can see the blue line, which is intraday realized variance. You can see it going higher by a lot. You can see the liquidity has disappeared. You can see the market has been really extremely unstable, and yet the red line, which is VIX, is doing nothing. You know, dealers are allowing realized variance to get really close to VIX. And why? No idea why. If you notice, at any other part of the curve, VIX has kept the distance. Most of the time, it has kept the distance from realized variance. Like they keep a healthy distance. But in 2022, they have not, and it's still a mystery why they have not repriced options correctly. So maybe they know something. You know, maybe they are in possession of information that we don't know, and that's why they don't want to reprice options. Or maybe their volatility sellers are back in force, like what we used to have in 2017, 2016. We have volatility sellers, and maybe they are pushing VIX down. But whatever the reason, is not normal. You know, I don't see why. Like, it's very obvious. It's very evident to all of us that that we are in a way more volatile environment, and yet VIX has not been repriced. So options have not been repriced. So something to keep an eye, something that is interesting, that is being consistent. Okay. I added a new slide here. This is a new slide that is called the variance risk premium. So I always talk about VRP, and there are ways to quantify it. So it's very simple, right? The blue line is the realized variance, the close-to-close realized variance for a whole month, and the red line is VIX. And variance risk premium is just the difference from the two. So I like the chart this way because you can see the periods where dealers were wrong. You can clearly see, for instance, whenever the red line is below the blue line, means that options dealers are losing money. Okay. So you can see that they lost a lot of money during the COVID crash because, of course, no one saw the COVID crash coming. So they didn't see it coming. Options were not appropriately priced, and you could get really cheap options. So realized variance came up substantially higher than VIX implied. And then after that, of course, there is a delay in the adjustment because this is like a whole month offset. So they finally start to adjust, and then the realized variance remains higher. They lose money again, and finally they readjust the way it is. Now it takes a while for them to readjust. So it's kind of cycles of they trying to guess, dealers trying to guess what is the right pricing. At some point in 2020, VRP reached 200%, which means VIX run 3 times higher than, 3 times higher than realized variance. So they really put a lot of pressure. And you can see that for most of 2021, the red line was above the blue line. They were overpricing options consistently. Towards the end of 2021, the whole thing started to go bad. The last weeks, you notice that dealers started losing money again, and the reprice that they did hasn't been enough. And at the early start of 2022, you see the blue line is starting to approach the red line again. And this chart doesn't include the action from today. And in the next couple of weeks, when realized variance catches up, it might be above the red line. So they might lose money in the next couple of weeks. And this is still the mystery. No idea why VRP has been so low in 2022. For reference, the variance risk premium has been running around 55% of realized since the COVID crash, but this year it has been around 20 and 30%, and I don't know why. It's very low for the mean. No, it is extremely low, and it's a mystery. The good thing about the options dealers is that they are not in the business of losing money. No, they are not in the business of losing money. So they will eventually start putting pressure into the options, and that's something I want to do. I really don't want to stop trading VRP. I really want to keep doing it, but I need to see that dealers are overshooting. I want them to overreact. I want them to overprice. I want them to do what they did in 2021, which is they just basically overreacted the whole year. So this is what I added this chart, and I hope that is clear. And if you have any questions, let me know. I'm going to pause for 10 seconds because that's what it takes for the questions to arrive. So I'm going to pause for 10 seconds and see if there are any questions. If not, I will continue. Okay, no questions, I guess. And if I run into your question, just please just type it and I will answer it. Now let's look at ambiguity. Ambiguity has been interesting. Ambiguity has been a non-factor in the whole. Okay, now I have a question. I knew I have a question. The way everything is priced, will the trade be an end of Western civilization lot to put? Yes, that will be the. If dealers are really not, let's see, if dealers are really not pricing correctly volatility, then yes, we should do an end of world, or we should do anything that takes advantage of that. And in the current environment, downside, it has the upper hand, no? So interesting enough, because of skew dynamics, binary puts are actually cheaper than binary calls. So so doing a tight vertical put spread is really advantageous, in particular if options are not being priced correctly. So yes, that will be a trade. The trade should be long gamma trades. So if dealers are not pricing correctly, we should go back to the ULG type of trades, to the trades that emphasize a long gamma regime. Like ULG 20, for instance, or ULG 40. And I think that in this kind of environment where we can have strong bounces, something like ULG 20 could work really well. And by ULG 20, I mean the naive ULG 20, like we just basically blindly buy the 20% binary call and then pocket the money. I think the edge will be gigantic. Okay. So let's talk about ambiguity. Ambiguity is around 0.12, which is nothing. Ambiguity is really low. It's not a factor in the current action. Nothing that has happened in the market is related to ambiguity, which means that the current action in the market is not seasonal. It's not related to just a long period of low volatility followed by a period of high volatility. No. It just means that the current action in the market is just basically, to me, is price discovery. Price discovery, which is this interesting force, is a very, I love that model of the market, when the market is modeled through price discovery. There is no agreement between market participants about what the price should be for assets. And this agreement breeds volatility, and that volatility makes the ambiguity lower and lower. So ambiguity is not a factor. Maybe we could track it in the sense that it could be an early sign of a market bottom. But we will need to see ambiguity collapsing higher and higher. No, so for now, it is not an issue. Okay. What is the trade plan? Okay, so at this point, this is probably one of the worst starts to the year I have had personally in my bank account. I think I'm down like 40 to 50K right now, and it's only 18 days in January. so I guess I might take a break. I might take a break on trading until something happens, until dealers decide to price this correctly, or until I come up with something that, maybe doing lotos, long gamma lotos, but officially I think I might pause the trades. I still plan to take the BRP 320 trade that we have for today, because the last time I checked it was really juicy, and juicy for me is something that is between 80 to 90 points down. Now that's kind of juicy. So if the trade by the close is giving us a margin of 80 to 90 points, I'll do it. If it's less than 80 points, I will not take it. I will not take the trade. And I will just basically don't trade for 2 months. I don't know, however it takes. I don't need to trade. We don't need to trade, folks. I mean, we don't need to do trades. And if there are no edges, there are no edges. If the edge for BRP disappears, it disappears. It will come back eventually, it will come back. But right now, clearly, for whatever reason, there is no edge because dealers are refusing to price the right risk. And to me, it is completely mind-blowing because I can see it. So if I can see it, I wonder why they cannot. They are supposed to be sophisticated guys, the guys running really advanced models, the guys running those things, and I can see it, and yet they don't see it. Or maybe they see it, and maybe they have information that I don't have, and that's why they are not pricing it the way it should be. So that's kind of the trade plan for now. I know you guys love to trade, but there is no obligation to trade. In particular, like, why do we want to trade if we are going to lose money? Okay, so let's take a look at the variance center. So you can see that it's a puzzle, that realized variance is very low. Like, we are in such a deep short gamma regime, and yet realized variance is only 14. And if you look at the realized variance for the 30 minutes, it's only 8.9. It's extremely low. What does it mean? What does it mean when the market is down 2% and realized variance is so low? Well, it is most likely that whatever is happening today is due to an absence of buyers. There are no buyers on the market, and it's not panic selling. Nothing that is happening today is pointing to people doing panic sales, like someone trying to get rid of a big portfolio. They are just dumping shares and they don't care about the price. No, this seems to be just people closing positions, and there are not enough buyers for them. And the other reason, which is if you notice between the open market open around 4,603 and right now it's 4,590, it's only 13 points. It's not even, the market intraday hasn't moved that much, so it's not forcing the hand of options dealers, it's not forcing the constant rehedging. So even though we have these tremendous imbalances, the current market action is not forcing the hand of the dealers to rehedge. They maybe towards the close they will have to rehedge at the end of the day, but for now most of the hedging I think was done at the open, because the futures were substantially down, so dealers were forced to sell, and that added downside pressure. But now there is nothing there. Maybe an entrepreneurial quant fund can come and force a little buying, and they will force the hands of the dealers to buy even more. But for now, I will say the action is very stable. Nothing is happening. Even kurtosis is really low. Kurtosis is around 3. It's 2.85. So it's pretty much anything that is happening in the market today seems to be very random. It seems to be very stochastic. Again, here in this chart of a historical realized variance, you can see that dealers allow realized variance to approach VIX. You can see how VIX remain, even though on the face of consistently higher and higher realized variance, VIX has very little bulge. Finally, today it has moved a little bit, but we'll see. Probably for the rest of the week, it will move higher. Let's look at New Ultra. So far we have an official trade, and the official trade is around 75 points. So it's not within the parameters of what I want, but it could change. It could change. So the limit is 4,515, and we are around 4,590, which is only 75 points of margin. I think they should give us at least 80 or more based on what is happening. So we'll see. We'll see if I'll decide to take it or not. In terms of the trade for tomorrow, I don't plan to close it. I'm still sticking to it. I did trim a little bit my position because I went too big last week by mistake. So, but that was only a little bit of trimming. But I still have most of my position on, and I plan to ride it. This is an all or nothing system. Let's see if we can get at least one thing. Of course, if we're like 100 points down tomorrow morning, I'll take whatever few cents I can get from it. But for now, I don't have any plans to close it. Okay, I'll reevaluate. Of course, my mind can be changed really quickly. So that's it. The only official trade, and it's kind of right there. Look, right now it's 505 and it's 88, so it's like 83 points. So now it's okay. It depends on whatever it is the strikes will get. 80 distance of 80 points or more, I'll take it. And that's it. In terms of what I'm seeing, interestingly enough, Ultra was well positioned for this week, and this is Ultra Classic. In particular, in terms of a standard deviation has been very elevated in terms of the predictions, and I think Ultra has been really accurate on that, the Ultra Classic, and that's the thing that it used to excel. Although it's a little overpricing standard deviation, I think for this week in particular it came out correctly. And that's it. If you guys have any questions, just please let me know. Let me come back to the presentation. Okay. So I have a question from Geoff. There does not seem to be many reasonable put verticals all the way to end of March for a nice lot to know that I have found anyway from a look I did this morning. Nothing better than 5 to 1. Yeah, I know. I mean, it's still expensive we compare with other regimes. Yeah, they are very expensive. But if we are short gamma and if we are consistently short gamma, bear in mind that we move almost 90 points down today. We moved 2% at some point today. So a 2% daily move could be extrapolated into like a 5 to 10% weekly move. So we could price a 10% down position from here. And you guys think 10% is 450 points, and you say no, that's unrealistic. But in a short gamma regime, 400 points is nothing, you know. 400 points can happen really quickly. In particular, if there is a surprise from the Fed. And remember, there is no upside from the Fed. There is zero upside. The Fed is not going to come and create a put like they used to. Like, there is not going to be a stimulus. The only thing that the Fed can surprise is a negative surprise. There is no such thing as a positive surprise from the Fed. So we could play that. We could play an end of the world scenario for a 10% move down into the Fed meeting, for instance. No, that's kind of a suggestion here. And I have a question, another question. Can you go into why you are only taking BRP 320 and not BRP 520? Yes. So for the two systems, I prefer the 3-day system because if all hell breaks loose, if there is a crash or if something completely unanticipated happens, you only have 2 trades at the same time. So only 2 trades go bad versus in 520, 3 trades go bad. Now, so I try to, particularly for short gamma trades, I try to keep my trades only a few at the same time and only as short time as possible. So, and also they seem to have a better edge in general than the 520. And for simplicity, now you have to say, like, I could take all of the trades, but I mean, I'd rather take just one to have a system. Another question from George is, if the BRP 320 signal is a short, in other words, to buy the put spread, will that be reflecting the variance center, or will you say no trade? It will say no trade. There is no short trading for BRP 320. Like, we don't buy the put spread. So, and the reason we don't buy the put spread is because even though there is still an edge on that buying, like there is an edge, the failure rate is too high. Okay, the failure rate for bearish BRP 320, I mean, just the success rate is too low. It's around 30%. So that means that out of 10 bearish trades, 7 will fail. But of course, the 3 that work will do really well, because remember, they paid 4 to 1. No, so you spend $1, you make 4. So you're making $12 on the ones that work, and you are losing $700 in the ones that didn't work. So you are $500 ahead. Okay. So that mathematically works really well, but in terms of execution, no one wants to lose 7 trades. You know, no one wants to lose. And I know, because we have tried, and it doesn't work. No, it really doesn't work. So in the variance center, the answer is the variance center will show no trade today. Like, the signal is no go, then it says no trade today. Okay. Okay, everyone, thank you for joining me in YouTube. If you have any more questions, please feel free to ask them in the room or through a private message. And I really appreciate that you join me in this really out of sequence type of live video. And it's always good to talk to you guys after an interesting week. Take care, everyone, and I hope that you have the rest of the day is good. Goodbye.